Hi, everyone, and welcome to Screw the Stock Market, the show where we talk about different ways to invest and build wealth outside of the stock market, all with the goal of building financial freedom, taking control of our lives and our futures and our finances, all to be able to kind of live our lives and do whatever we want to do and go crazy. I'm excited. Aziz, today's show is pretty cool. We got a crypto guy, Joe Robert,
Yeah,
right?
yeah, Joe Roberts. I hesitate to call him only a crypto guy because
It's
I
true.
mean, this guy pretty much did everything. He's done real estate, he's done construction, he's done, mortgages. I mean, he's done the full round of just about everything. He just happens to now be the CEO of a crypto fund where he manages crypto assets for clients, which healthy 10% return, which is pretty good for crypto.
I bet over the last few
Like,
years, yeah.
Yeah, consistently at least. I
Hmm.
mean, I know there's higher returns, but like at least consistent. So, but yeah, but he's definitely an interesting guy. I mean, like a wealth of knowledge. I mean, we learned some tax tips from him. Um,
Might be moving to Puerto Rico.
yeah, yeah, essentially. Yeah, but this was a good one. I had fun with this conversation, and I learned a lot.
Very cool. Well, again, yeah, we it was just a good show, good episode. He's a cool guy. I felt like we were just hanging out with one of our friends, man. He was a real cool guy, and I hope the listeners are able to get a lot of value from it. He's really done it all. He's done just about everything that we've talked about on this show, which is pretty cool, right? He's done notes, he's done businesses, he's done funds, which is one of the next ones that we gotta find a fund guest.
Yeah.
I guess we had him today. So without further ado, enjoy the show. Joe, thank you so much for being with us today. We're really excited to have you. You're a real estate guy, but you're not a real estate guy, or maybe you were. We're gonna get to the bottom of it. We're excited to have you on.
The man of many hats.
Yeah, so normally at the beginning we just give you an opportunity to introduce yourself, tell us a little bit about who you are, where you came from, and how you got to where you are now. And then later we'll dive into a little bit more of the details on, the technical stuff or whatever it is we're going to be talking about. So let's jump into just an introduction. Tell us about yourself.
Awesome. So my name is Joe Robert. I grew up in the Philadelphia area, and Alex and Aziz, thank you guys for having me on, and for providing value to all your listeners today. Probably how it all started, I think, just as a young kid, I had a desire to make money and go out and do it on my own. So it started from snow shoveling around the neighborhoods when I was younger to younger teenager. I was then a landscaper to mowing lawns in high school. I didn't really care for school so much. So in my junior and senior year, I had the ability to be able to go over to tech school and get out half a day for construction work, right? It was the only one of the mechanisms at that time that allowed you to get out of school. I was like, so I was happy at that point. And so what happened was after high school, I actually then had my company, JR's Contracting and Landscaping, right? Where I did both areas and service people for a period of time. And then I kind of gave up the landscaping work and went more into the construction work. So that led me to acquire my first property at the age of 19. This was back, this was a while ago, about 20 years or so ago. And, back then, there wasn't anybody at 19 buying properties, when I was graduating, these people, and kind of our profile said self-employed versus today it's everyone's an entrepreneur. You know what I mean?
Absolutely. You're right. Yeah, that is trendy.
At 19, I didn't even, the idea of even being able to purchase anything, let alone, I could buy a movie ticket. That was about
it. Hey, look, it was a hustle. I didn't drive the best car, the best new car as a teenager. I definitely paid for my own things. I chose to pay for my own insurance and be independent. This way I kind of looked at like my parents couldn't take it away because I was paying for it. So if I got in trouble, they couldn't take it away. So after that first property, I lived in that, fixed that up, and sold it after 2 years. So for everybody listening, if it's a primary residence, there's those tax advantages in the U.S., $250,000 if you're single, $500,000 if you're married, right? So I took advantage of that and sold that property. From there, actually, off my mother, she started investing down the Outer Banks of North Carolina. And so I started doing some work with her and acquiring some properties, doing some fix and flips. We did some small lot subdivisions, and we were kind of speculating on land. Now, this is the 2000s, right? So you probably know where the story is about to go. Do you guys know where it's going to go?
Oh, yes.
I was around. I remember. I remember getting offered. I met a lender one time on a plane, no job, no money, He was like, "Hey, here's my card. I'll help you buy a house." I was like, "I have nothing. Like, how can I buy a house? Maybe I should have. Who knows where I'd be? But I think I know what you're
Probably
getting."
better not. By the time you got that offer, it's probably already too late in the cycle,
Oh yeah.
you know?
Oh yeah.
So what happened there, obviously the real estate market crashed and, I stopped investing for a period of time while I kind of reorganized everything, was able to get back out of debt and start picking up real estate again in about maybe 2011, 10 in the Philadelphia area. I started fixing up properties, and on one property specifically, a private investor I was working with decided that he wasn't going to invest with me again. I said, "Well, what's happening? I'm paying you 15%. He's like, "I'm moving my money over to this other fund at 18%, right? Now, today, that's kind of high numbers, maybe, because 10 years ago, there was more of a distressed opportunity in the market than you see today. So I was like, "Well, what's happening?" Well, basically, they're buying distressed mortgages, and he's been going to local meetups. So I started attending myself. And from there, I got very excited and intrigued because, coming out of the 2000s crash, like you owed the bank's debt, right? And so this way I was on the other side where I was able to buy the debt and people owed me money. So at that time I was like, this is cool, right? This is really cool. And so I started buying loans then. I hired another guy to do my initial workouts to kind of validate the thesis and the idea of investing in mortgages before I shifted from real estate over to the distressed mortgage market. And after about 6 months, I got a return of capital and I was like, okay, I'm sold, right? So I partnered up with two other people. We formed a company together and started buying pools of loans and distressed mortgages. These were pretty much second mortgages that were underwater from the 2000s from all the origination of the piggyback loans.
Now that's interesting. I mean, how did you go about actually purchasing the mortgages? I mean, did you have to go through the bank, or there's special processes? Because we've heard this before, but it's still kind of obscure to me. Like, how would you go about just purchasing a loan?
That's a good question. That is great. So there's many different ways, and it depends on your buyer level and how much capital you have to deploy, right?
Right.
So if you're a buyer, probably 6 figures, we'll call it, right? You're using 6 figures. You're probably going to go to a existing fund that has that inventory, right? And that fund either bought it from another fund, or they maybe had bought it from the bank direct. So typically, what kind of happened was larger funds would buy, let's call it $10 to $100 million pools purchase price, and they would maybe internally work some out, or they would carve some out and retrade it back out to other funds, and then those funds would trade it back down the waterfall. So the answer to your question is it really depends on where you're at in the stack. If you're a beginner, you're probably going to go to a fund. You may also go to another fund, and at some point you go to the banks directly.
Now, how do you find the funds normally?
Well, I think like all industries, once you get involved, it's pretty small and you learn who the players are quickly. Does that make sense?
Yeah. It's a tight-knit circle. You just kind of ask around and someone will direct you to somebody at some point.
Yeah. Now, the thing is with buying mortgages, no different than real estate, right? When you own the title to a mortgage, you have a assignment of mortgage, and that information is on public records, right? So like properties, if you go to public records, you could scan who are owners and what funds own these mortgages, and then you could try to outreach and contact them directly.
Oh, interesting. Clever. I hadn't thought about that. Yeah. So I do want to also highlight for the listeners too, we have an earlier episode just entirely on note investing. So our guest in that episode, Z, Ananzi. So she, feel free to check that out and dive further into those details if you want, because it's cool. But I don't want to take away anything from you, Joe. So, but yeah, please continue. So you went from mowing lawns to real estate. You were able to rebuild after the crash, still in real estate.
Yeah.
And then now you discovered notes.
Correct. So I kind of dropped the real estate at that point, and we were just buying loans, me and my two partners. And then 2014 came, and I always heard about Cayman Islands and all these different tax jurisdictions, right? We're always curious, everyone wants to save on some
offshore
taxes.
accounts.
And at that point, I think it was Obama, was kind of cracking down on some of that foreign stuff, and they were going through the Swiss banks and everything. And so I went to my lawyer. I was like, look, is there any legitimacy to these jurisdictions that get tax breaks? He's like, yes, but you have to actually be a resident to get full tax breaks, right? He's like, but I heard something about Puerto Rico I know nothing about. So like anyone would, you go home, you check Google, right? You start Googling it. And I find out quickly that they have some tax incentives there for people that would like to come down and contribute to the island. And so it was a few months later, I got on a plane, went down there, booked an apartment, and my partner and I moved down there. And then we started building some relationships with the banks directly there. There's only a handful of players. And so it was easier to be able to establish those relationships. And we bought some pools of loans. And we also were able to get pools of REOs. I think, if I'm guessing, probably invested in over 150 properties down there, anything from residential to commercial, hotels, chicken farms, you name it. It came in the package.
Very interesting. That's pretty unique.
That's interesting.
Now,
also, side note, we have some friends that work in the financial sector. Apparently, Gibraltar is the new hotspot now for funneling money through.
Yeah, it's definitely been one of the ones that has been on the in the crypto space for the last handful of years. But like everything, you're kind of screwed if you're a U.S. resident. In order to get most of the tax breaks, you have to actually give up your residency and move to these locations.
Yeah, there's a lot of people heading down to Latin America and then funneling things through Gibraltar, is what our friends were telling us. It seems to be the big thing.
You can get creative. Just remember, everything that has a digital trace is traceable at some point today or in the future. Right?
Yeah.
Well, that was their job, to trace the money.
For the first time in the history of this show, I feel the need to have a disclaimer that none of what we say is advice, and you should not avoid taxes. You should not do anything illegal. But I guess giving up your citizenship or residency is legal, right? You can choose not to be American, and yeah, because the U.S. definitely has a worldwide view. Any cent that you make anywhere in the world, they think they're going to get a cut of it, and that's pretty painful.
Didn't one of the founders of Google end up renouncing his citizenship and moving to Singapore?
A lot of those billionaires do it. Yeah.
A lot of people have gone to Singapore the last few years.
Mm-hmm. So
yeah, so I mean,
all right. So you're buying loans and REOs. You're doing a lot of stuff. That's super unique, though. Now, I guess we didn't really talk about scale throughout the story, right? Like someone's buying notes, you could still be, I guess this hint that you bought directly from a bank, and you gave us a hint earlier that when you start buying directly from a bank, you're at a certain level. You start to be at a certain scale. Can you give us some hint? You don't have to name numbers.
Yeah, I'll reiterate that. So probably a lot of the stuff we were buying is anywhere from I'd say we were buying stuff probably in the a couple $100,000 to $5 million per purchase range. Mostly actually came out of funds, because if you think about a timeline, actually what had kind of happened, 2006, 7, 8 crash, Bear Stearns, right? So 8 to 10, 8 to 11, 8 to 12, they sold most of that, a lot of loans to other larger funds. So we got in at 2011, 2012. So we were actually buying from these funds that bought from the banks at that point.
I see.
Now, through our relationships over the years, we were able to acquire some notes from the banks as we built those relationships. But a lot of the loans were then at that point held by other funds.
I see. Okay.
And in regards to some of our listeners, because when they hear like some of these figures and these processes, they get overwhelmed. Were these the financing for a lot of these purchases, were those coming out of your pocket, or did you have investors, like some big money partners? How are you financing a lot of this?
Yeah, so that's in 2012 we did our first fund, where we took in accredited investors and maybe several unaccredited. That was $1 million we raised at that point, which was our beginner fund. And we also were using some of our own capital. Then maybe about a year later, we actually partnered up with another fund that we have a great relationship with today. And they manage about 100 million or so assets at this moment. And they were actually funding us directly without having to go to the market and raise more capital. So the takeaway for the listeners here, one, you can raise capital yourself and go out and do an offering and kind of do the network and so forth. Two, you're going to find a capital partner that has all the capital, but you're going to give up more equity, or you're just going to pay a higher rate typically. But depending on where you want to focus in your business and how you want to allocate resources, that might be a better way, right? So sometimes just focusing on getting those deals might be what you're better at operationally, and then getting a capital partner, paying a premium, it can be a better way of going about it than doing a fund yourself and having to worry about covering everything.
Gotcha.
No, that's awesome. That's exactly, that's what I'm trying to do all the time, right? Raise money or make those connections. And yeah, there's definitely the appeal of just the efficiency of just knowing that the money's there. Let's just go out and buy this great deal. I'm with you. That would be nice. Hey there, just wanted to take a minute to thank you for tuning into the show. It really means a lot to us. We hope that you're getting a lot of value out of it. And in that spirit, we're trying to find other venues to engage with you to be able to continue to share value in different ways. So we want to encourage you to go ahead and tune in and follow us on Instagram at Screw the Stock Market Show. We have a YouTube channel set up where we'll be posting entire episodes and other relevant content there. And on our website, screwthestockmarket.com, where we'll be posting focused on kind of action steps and other resources for you and for us to be able to take action with the lessons that we're learning from all the guests that we're having on the show. So thanks again for tuning in, and we hope that you're getting a lot of value from this and enjoy the show. Okay, so now we're in Puerto Rico. You just bought a bunch of loans and REOs. What's next?
So I guess one thing, for listeners here is they may not be familiar with Puerto Rico, right? And understand that tax advantage. And so effectively, you can pay approximately a 0 to 10% tax rate, right? So if you move down there and you're investing in certain assets, you could pay a 0, with capital gains, you could pay 0%. They have a 4% corporate tax rate at that point. And depending on how the income is allocated, I say 0 to 10, right? So that's a great savings. It's a great for, improving and building up your business, right? Because it allows you to reinvest more capital.
Yeah, I had no idea. So for that, is that if you're investing in Puerto Rico, if you live in Puerto Rico and invest in Puerto Rico, what if you...
It's a little bit of everything.
Okay. And that...
If you invest in Puerto Rico and Puerto Rico, like real estate, etc., yes, that includes there.
So you have to be a resident of Puerto Rico.
Yep. And I always like to say, you got to be a real resident. That means you got to live there over 183 days. It's got to smell. It's got to pass a test. Your doctor, whatever it is, everything's digitally traced.
Again, you come back to it, yeah.
Well, everyone always goes, oh, well, can I take a boat? Can I take a jet? Can I do this? And I'm just like, look, everything's tracked these days. You want to play in the legal zone. So if you're going to make one of these moves, you want to be a legal citizen. You want to be there. You want to reside there. You want to abide by the law.
What about proxies?
About what?
Proxies?
Yeah.
Could you have like a proxy that happens to be a resident there?
Yeah, so that's
get into the gray zone.
So yeah, I mean that's like I said, yeah, you can't go through another shell, this person, another person. It's best to just be there.
So when you find legal counsel ASAP.
But for those that are interested, that's a great area to go for taxes.
Wait, I'm sorry. I just want to make sure. So this will count against even your federal income taxes too. So it'll reduce your federal tax liability in addition to just kind of a state level.
Correct. So the way it works is it's Puerto Rico's with a territory within the U.S., but it has its own basically federal tax system. So they can put in laws for their own citizens, right? So when you become a citizen, now you're under the hacienda or under their jurisdiction. And then they give you a tax decree, and that allows you to pay that effective tax rate on an annual basis.
My goodness. Very interesting. Okay. That is news to me.
But there's two great things here. Puerto Rico is great, has great weather, got great taxes. It's got happy people. They're loving life. They got beaches, and then some people may be there for a period of time, and they might miss some of the services that you have stateside. So no matter where you move around the world, for everybody, just remember there's certain services and certain things you're accustomed to and growing up or where you might reside that might not be at these other places. So always go there for a couple months and see if it's really a fit for you, because there is a lot of people that do move back quickly or in some form of time because it's not quite what they expected.
Yeah. What a balance.
I think it'd be answer. Too much.
That's just so, yeah, man.
I mean, for those of you who know, both Alex and I are both immigrants, and we both worked in international development. So going outside of what we would call the normal American comfort zone is pretty normal for us.
Yeah, can handle it. Yeah. Okay. So, but eventually you did, right? You're not in Puerto Rico anymore. So eventually you decided to come back.
Yeah. So let's see. I guess, kind of pick up where we left off is we were acquiring assets there and just going to some, occasional parties. And I met people in the crypto space. That's kind of what happens when you have a lot of different people kind of coming in. You all see what everyone's doing in their business. And it was probably the spring of 2017. I was interested, but I was trying not to get sidetracked. If you stay focused, that's the best thing to do as an investor. And so I was just hanging out with people. And by the fall of 2017, I made my first purchase, right? And I was just testing the waters at that point. And for everyone listening, as an investor, you should always, my take is, not financial advice, my take is you should always be testing the waters if you're going to go into somewhere new. Spend some amount that you're also willing to lose, because one, it keeps you attracted, it keeps you paying attention, and has you watch and research your investments. And most likely, a lot of times, those investments you make in that initial period, you may have some losses on, right?
And it's funny that you also mentioned that, and also specifically spring of 2017, because I think that's when Alex and I both kind of dipped our toes into the crypto market for the first time. It was not a good experience, but it was a learning curve, and it was good. It was a good learning curve.
Yeah, I like to say, typically when people buy their first crypto, somehow the next couple of days it goes down the other way just to check their emotions to see if they're willing to commit long term.
Well, we would have been fine, I think, had we stuck with the main ones, like had we stuck with Bitcoin, maybe Ethereum. But then we got pulled into the hype, and next thing you know, we're buying like lumens and all these just random coins all over the place, and a couple of months later, it just all went downhill.
So basically, the stock market was too plain, the returns weren't great, and so you were trying to figure out how to screw the stock market by going in the crypto market, right?
Yeah, essentially. But I mean, our fault was that we didn't do enough research at that point. We were just listening to just random coworkers who would just spat out random things at us, and we were like, "Oh, okay."
And they'll remain unnamed.
That's what I
say.
Yeah.
For everybody listening, take that first 6 or 12 months and really learn what you're investing in, because that's where most of those mistakes are made in anything you get into. So don't dive in 100% with your capital up front.
Yeah.
So basically, by the fall of 17, I started acquiring some assets. Beginning of 18, I hired the two guys that have been in the business a little bit longer than me, because I was newer. And so I was looking for a little bit more expertise. We started investing in some of the startups and ICOs in the first 6 months of 18. And then kind of realizing that we were actually on the back half, or started the bear market already, right? So, as I mentioned, in the first 6 to 12 months, you usually learn a lot. And so we learned quickly that we were actually heading or going in a bear market, and making those investments was not the best decision at that time. Fast forward 4.5, a couple years later, I have, the wife, and I have 2 kids, and we decided we wanted to come back stateside and come to Raleigh, North Carolina here, just for what we wanted for the family, services, and etc. And now we manage the portfolio of crypto for 4.5 years. We have about 10 to 12 different venture investments and other funds. We still have some real estate, and that's what we're up to today.
Okay. So you didn't lose your shirt on the downslide?
No. I didn't go all in. Like I said, I learned from the 2000s.
Okay.
I learned in my 20s.
Yeah, you had done it. You're right. You'd been through it before. So you still had your real estate, you still had your notes, you were still kind of figuring things out. But would you say now you're a crypto guy, or would you?
Yeah, I mean, right now we're probably I still have some real estate investments with one partner and some stuff here at the beach again. I wouldn't say we're always on the lookout, but we have some relationships. Like if anything does come by, then we'll take a look at it. But I would say 90% of my time, or 95% of my time even, is allocated to the blockchain technology and digital asset space now. From an investment standpoint, same.
Very interesting. Okay. So Aziz, maybe I'm going to let you take the lead, because we're in a crazy time in crypto. So I'm going to let you just talk directly to the
crypto
audience.
Bros, our hair's on fire right now. Market is crashing.
So yeah, I guess for people who might be listening at a different time, maybe you could just set the stage. What's happened over the last few weeks in crypto? All I know is it seems like it's been bad. and then you could just tell us kind of what we should be doing. What I'll let you go. I'll let you go.
It's only like a couple of months back, Bitcoin was like what, 60,000? Now it's like 30.
It's only 50% haircut, right? I mean, technology stocks are seeing the same damn thing. The stock market's bleeding out even more in some areas, down 70-80% on some of that tech stuff that went to the moon, right?
Right.
So Bitcoin's actually having almost a less of a drawdown so far. We'll see what plays out in the next 6 months. I think what happened at a high level is we had a lot of inflation the last couple of years, right? We had a lot of money printed, a lot of money added to the whole entire system across the whole entire globe from all different economies, right? So crypto is definitely global. So there's a lot of participants that can jump in the market. What happened in the market is we just got too far. Too many different projects were coming out looking for capital. It got overheated. There was no more buyers left in the market. It got exhausted. And therefore we found a top, right? In technology and early emerging markets, you tend to see these hype cycles a little bit more often, right? So capital comes in and it gets overextended, and then it resets, probably too much, more below the average. People start buying that value, and it comes back. And like if you look at Amazon, Apple, all these things were also a participant over the last 20 or 30 years with the same type of cycles in the early years.
Yeah, I think part of it also is the Federal Reserve raising the interest rates, because every time Powell comes out with a new rate hike, everything plummets, crypto and stock alike. And I think people just automatically panic and shift out of anything that they view as kind of more of a riskier investment, and they try to run back to anything that's safe. But the conundrum I have with that is that in many ways, Bitcoin has become the new gold, which is normally what people rush into during times of inflation like right now. So I'm very confused in terms of what's going on. It's really just an interesting time to be alive.
Well, I think gold hasn't performed at all the last few years, right?
No,
so it is interesting times, Aziz. I mean, that definitely is the case, right? I mean, this is slightly uncharted territories with the printing of the money. I mean, if you were to look back at March 2020, I mean, I would say everyone was predicting a meltdown in the world economy, and all of a sudden, a few months later, we're back to like booming highs.
Yeah, that was
unexpected. It's very true. And honestly, I mean, considering the cycles, I think once a lot of these interest rate hikes stop, because they're just parsing them out little by little right now, and every time they do another one, everything crashes again. Once that kind of stabilizes out and they do the final one, which will probably be by next year, I think things should stabilize and start ballooning again across the board. I'm hoping, at least.
I mean, here's where
my portfolio hopes so.
Yeah, I mean, I don't do much forecasting or I don't come out with price predictions, but I would agree with you in the sense they're probably going to raise a few more times in some capacity, right? At some point, probably in the next year, they maybe realize it probably was slightly too much, maybe, or too much slow growth, and maybe they adjust a little bit down. So maybe the new norm is 5 to 6% interest rates. Maybe we peak at 7 to 8. But I think the economy as a whole is still strong, and so for all listeners, when you're making that investment, if you're looking out at a 3 to 5 year time horizon with what you're investing in, then you minimize a lot of risk in your portfolio. And so when we talk about crypto kind of bleeding out right now and being in the gutter, along with even the stock market that we all hate, right? It's a great opportunity to find value assets in this time in the next probably 12 to 24 months that you'd be willing to hold the next 3 to 5 years, because that probability is high that it's going to be at a higher price than today.
I like that.
No, definitely true. Yeah. I mean, it's funny because I watch a lot of CNBC as well. So, and a lot of the analysts there will be naysayers a lot of times on crypto, but they'll all admit to it. It's like, yeah, I own some. You have to own some. It's obvious. It sucks, but it's obviously you have to own it. And then the next 20 commercials you see is for like, a crypto investment firm or a new Bitcoin reserve or something like that. But it's institutionalized at this point. I mean, I feel like every major financial institution has bought into crypto. It's too big to fail in the long run. I mean, depending on the type of crypto, but.
And I want to say,
Ethereum, definitely, I would say.
I totally agree there. The institutions are definitely starting to play. They're setting up framework. They are still waiting for some regulation clarity, which there's some proposals in. Maybe it doesn't even happen until after these fall elections, but somewhere next year or two, if I had to guess. And then a lot more capital will come in for the next cycle. And 3 to 5 years out, I think that performs great. When it comes to crypto, I think when they say the word crypto, they just think that's the whole industry, and that's not just the whole industry, right? So there's a lot of technology companies here that are also doing different things like software as a service or whatever that may be that you can invest in. It's not just crypto. There's data software services, there's exchanges, there's all types of different things. There's people are building out a lot of different services for Web3, just bringing that ownership back to the creators and having that direct relationship with who they do business with. And if you don't like crypto yourself, there's other ways to participate.
Well, that's interesting. Yeah, we I guess because that's kind of the question, right? Like, and this is one of the questions I wanted to get to with you is like the difference between speculation, right? Where, hey, I bought something at a certain price and I'm just gambling and hoping and praying that it's going to be worth more later, and then I'll sell it. And then that's speculation. And then I think what you're getting at is maybe a longer term vision and some sort of a connection to the actual value that's being created by a technology. And that's exciting, right? Because and I honestly haven't heard a ton of examples. Maybe you might want to go into some of them for us in terms of how things are being changed. Like, I don't know, the one that's been on my mind as a real estate guy is the idea of, I do syndications, right? People buy a certain percentage of an apartment building with me, but then they're kind of stuck with it. It's not liquid, and they have to wait for me to eventually hold it, increase the value, and eventually sell. And I heard about one example where there's tokenization of that share that they own, where now, hey, this is a unique, I guess, blockchain kind of thing that proves that you're an owner of this share. And now it's a little bit more liquid, where they would, in theory, be able to sell it on a secondary market and kind of go in and out of apartment buildings a little bit more quickly, which is interesting. That's really one of the big drawbacks of investing with me is that, hey, your money's tied up and you can't get it back until the deal is done. That might be a really appealing thing for me and my investors. So I don't know. I'd welcome you to share if you had any other kind of tangible examples or any other thoughts on the difference between speculation and investing.
All right. So I think we have we have like 5 things there.
That's the sign of a beginner podcast host. One question at a time.
So let's hit on the speculation versus investing, and then we'll hit on maybe some use cases and different ways that the tokens and so forth can visualize, right, for the listeners.
And that's the sign of an experienced podcast guest. Thank you.
That's good. So from a speculation standpoint, I take the approach is, in a sense, everything in life is speculation, meaning you can't forecast or know what the future beholds. Everything just has a different risk profile, right? So a piece of real estate, you have a lot of data, you have historical data, but maybe a meteorite drops on that property tomorrow. You couldn't forecast that, right? So there is some level of guessing, hey, rent's going to grow 2-3% per year. People are going to move here. The average income is here and so forth. But there's other things that could change that. So that's kind of my thing from a high level. Everything has some aspect of speculation. Now, there's different probabilities and different risk metrics depending on how you allocate that to assets. So the difference in speculation investing is that the probability of your outcome is much greater when you're probably, if you want to benchmark that to investing versus speculating, right? When you are less unknown about what that outcome can be, you're probably speculating more. And that risk is going up a lot higher. And that's how I look at the difference between the two. Yeah, I mean, let's start there.
I think that's just a really sound mathematical approach, right? It's just probabilities and statistics about that. And one thing I'll add, I guess, to having been there with that Bitcoin purchase that I made in 2017 was, first of all, I knew nothing. I literally just saw a trend and just hoped that the trend would continue.
FOMO.
And there was this emotional component. It was the fear of missing out that was just driving me, as aside from kind of a neutral, well thought strategy, right? So yeah, I think that's a really good answer to the difference. And it's also a good point because you acknowledge the fact that no one knows what's going to happen in the future. Even in the smartest, in quotation, investments, there's risk, right? Always. And so yeah, I think that's a great answer.
Correct. And I think the difference between also, let's say, crypto and the stock market and real estate is it's a liquid versus illiquid investment typically, right? And therefore it allows different emotions to come into play at certain times. And this maybe will lead into our next sector, but let's say, when that price goes up and down, it messes with your emotions and then allows you to, and therefore most people buy the tops and sell the bottoms, right? It's kind of what they actually do, because by the time the most FOMO kicks in, that's at the point in which it typically is topping out. And then when it's gone down the most, it's typically where they can't take it anymore and they just give up, capitulate, and move on. So real estate and other assets that are illiquid can be better for those investors that are not great managers of that liquid asset.
Like me. I'll say Aziz talked me down from the cliff. That we bought Bitcoin, it was getting more expensive, bought a little more, and then it tanked. And I was like, oh no, I made all this money disappear. I'm going to sell it and just kind of cut my losses. And he's like, no. That's exactly what you don't want to do. So thank you, Aziz, for saving me, because it went up again and we still got it there. We still got something there.
Yeah. It's actually funny when you say the emotional component, because Alex, you could see the full spectrum of emotions. I mean, there was sweat just dripping down his face the whole time.
My wife still hasn't forgiven me. She still hasn't forgiven me. Yeah.
I think that's probably where the sweat was coming
from. It was all that. That's the only concern, was just she's going to kill me.
So let's piggyback that, right? For everybody listening here, right? We're talking about liquid versus illiquid, and we mentioned real estate and tokens, right? So the great thing about real estate is it's illiquid, meaning if it traded from day one, think about this. You take a value add apartment, you buy it at X price, and the next 6 months, if you have units go vacant to do rehab and you have those rehab costs, right? In theory, if that was traded liquid based on that month's cap rate, the value would go way down, but no one really sees that. They only see the 3 to 5 year exit. But if it was traded from day one based on that last 30-day financial, based on the average cap rate of that area, you might actually have the price of that apartment go down. So that's one benefit or drawback to actually tokenizing the shares of certain real estate, right? For those that are buying, you might find weak hands, and for those that have strong hands, it doesn't really matter. The benefits might be, typically when you're doing real estate tokenization right now, you're going to have to wait a year before that can actually be traded because of SEC rules. And, the benefits would be like, hey, if you're a sponsor, you take on a project and maybe you just never want to sell it, right? It allows people to free trade those security tokens and get in and out of position without having to sell it to, provide that return for your investors. So let's move on to also next example.
Okay.
Airbnb on the real estate side, right? You put up a property on Airbnb, you get great reviews. What happens if you go to booking.com or Vrbo? You got those reviews?
They stick with the one site.
Yeah. So kind of when we talk about Web3, this is what we're talking about. These are the type of problems we're trying to solve. We're trying to solve for people being able to take control of their own assets or be able to take control of those, let's call it reviews, right? You should have, let's call it like a decentralized platform, but basically where it aggregates those reviews and it can be plugged into these different services, right? You should be able to own and I wouldn't say necessarily control, but own your own reviews and be able to post them on the different sites. Because now you wouldn't have to start over on a fresh site every time a new service came out. That's a great maybe example.
Yeah, I mean, that's a clear definition of Web3. Because I know a lot of people get confused over the concept of Web3. It just means you own anything that you post on the internet, as opposed to your internet provider or whatever website you're using owning it. And then you have to ask them to give it back to you or transfer it to somewhere else.
Yeah. And last week I was at a meetup and, a guy in the music industry said that a lot of artists only get up to about 10% of the gross income. Like it goes to record labels, it goes to bookers, it goes to everybody else in the middle. He says like it's actually disgusting is how he put that. And so I think across all the board, whether it's Spotify, Apple's store takes 30%. We heard about, Epic Games trying to sue them, right? These are all things in which Web3 is trying to solve or make more efficient the marketplace to bring more value and money back to those creators. And so it's not all about just a crypto and buying a crypto, right? There's a lot of different things here involved.
No, definitely. Even in terms of social media, I mean, if you're posting something on like YouTube or Instagram, I mean, you have to get hundreds of thousands of followers before you see any significant returns. Meanwhile, the company who owns the platform is making millions and millions, if not billions, off of all of those views. And you get like pennies on the dollar. But if you owned everything outright and you could, transfer it anywhere you want as easily, I mean, you're collecting all the revenue directly. You don't need, another platform, really.
If you're Donald Trump and Twitter don't like you, they just go in and push that button and you're out of here, baby.
Yeah, they can make you disappear. Very interesting. So, Joe, I guess I have one other question. We don't have to end it right now. That's the cool thing about podcasts. But just one question occurs to me is just, do you have like a call to action or something that our listeners might be able to engage with you, whether it's investing with you? Like what exactly is your, I don't want to say it.
Yeah, I mean, yeah. So I mean, like there are two things, right? So best way, you can always find me on social media, Joe Robert, Joe M. Robert. But we have a newsletter that goes out weekly in the crypto space. It's an article, it's a couple of tweets, it's an interview with a project in the space. It's a great way to understand questions we ask, learn more about insights if you're actually looking to invest. You could go to joerobert.com and subscribe there. Again, I would love to have everybody, subscribe weekly. Over at Robert Ventures on the fund side, we currently are launching actually, right now, and we're going to be coming out with 8 and 10% fixed rate product for all those that are looking for that fixed rate return for a 3-year period. It's something we did over the last 10 years with other investors. And so we're bringing that same product to the market. We just find that, some people like performance-based funds in certain areas. Some people like fixed rate, some like a combination, depends on their income needs.
That's really interesting. I like that.
And now, is this a product of your own design, or are you kind of leveraging different things into like a special kind of portfolio that you manage yourself?
Yeah, so basically it's just a debt offering into a holding company that we're managing ourselves.
Gotcha.
Okay, great. And so, we're also making our own commitments, as I mentioned, and, we've worked with other investors in the past 10 years. And so that's our experience, and that's the way we're going with it again.
Nice.
Very cool. All right. So, Aziz, do you have any other questions?
No. I mean, I feel like I learned a lot on this call.
Yeah, this is really good.
Yeah, I mean, we've covered so many topics today.
Yeah, this is probably you might be the broadest guy we've ever had on the show. Like, you've really done a lot of different things. And
I feel like I've done nothing with my life now compared to you, Joe. I'm reevaluating a lot of things.
Man, drop some hints. I think we're all about the same age. I don't know.
Oh, yeah.
40 this year, next month, something like that. Next month.
Yeah. Us too.
Yeah.
A little younger. I mean, we're a little older than you, but no, that's very cool, man. It's been a real pleasure. We've really enjoyed this, learned a lot. And I think the breadth of your experience has been really, really interesting. We haven't done much hatred on the stock market. So I'm just going to let you close us out with just some hate, if that's how you feel.
All right. Well, I look at it like this. One of the slides we have to our deck for everyone listening, right? If you look at bonds, you look at S&P, you look at real estate, then you look at technology over the next decade and the projections. Technology is supposed to way outperform the stock market and bonds, right? So what is it saying? You skate to where the puck is going, right? Mm-hmm. So that's why I'm going there. And that's why you should probably focus when you're making investments to where it's going in 5 or 10 years. Even if you're buying a piece of real estate, like what's the vision and what's it look like in 5 or 10 years? Like, are they going to put Whole Foods? Is it going to be a city center? or is everyone moving out? So have a vision for the next 5 or 10 years, what you're investing in, and invest in emerging trends, where there's a lot of growth that's going to outpace the stock market. And I never invested in the stock market really. So, I mean, I'm not, I definitely don't dig it. You know what I mean? It's like go against the grain, contrarian if everyone goes somewhere else, right? So I go to crypto where everyone hates on it,
Very cool.
No, yeah, definitely. We definitely liked and loved your perspective. I mean, as I said, I learned a lot, got some gems, and I feel like we just basically just scratched the surface of things that we could talk about. We definitely need to have you back for more in-depth conversation on some of the things that you brought up today.
Yeah, I mean, we could always go deeper. We could always go deeper in the different areas.
Yeah, most certainly.
Well, Joe, thank you so much, man. Really a pleasure having you on the show, and we'll make sure to put those resources in the notes for people, and then we'll go from there. Thank you, man. Really bless you.
Alex, Aziz, and all of our listeners, thank you.
All right.
Thank you so much.